Hello, everybody. We are back. It is Wednesday. Let's see, what day is it today? It's April 19th. Happy birthday, Mr. Radigan. Happy birthday.
Thank you. Thank you very much. It's my 51st birthday. Somebody referred to me on the street today as old man. They said, "Hey, old man." And I knew it was a problem because I lifted my head and thought they might be talking about me. And they were.
That
never happened before. Never happened before. I'll tell you, this is the first time it ever happened.
Yeah, it's bad, and it goes downhill fast from here.
I can see this is now it's a mess.
Yep, it's a mess.
So I'm feeling philosophical, and I'm feeling extremely optimistic and extremely pessimistic all at the same time.
Yeah. Now you're going to feel better when you're having. When you're sitting down at a diner in New York and the server comes over and she says, "Hey, hun, what can I get for you?" You're going to feel better all of a sudden because she's not saying, "Hey, old man."
Hey, old man hurts. Especially, hey, old man is fine. You can say, anybody can say, "Hey, old man." What hurts is that when I heard the words, it meant enough to me to lift my head and see if they were talking about me. That's what hurt. And when I did, I was right. That really hurt.
Happy birthday.
Thank you. I appreciate it. So can I tell you some of my reflections upon another turn on the sun, both the most optimistic and pessimistic?
I can't stop you. It's your birthday.
So first and foremost, we have the situation with the Dominion and the Fox and the $800 million. Which, again, I'm not interested in the politics, but I would just like to say, because I know Wells Fargo is one of your least favorite enterprises. And then there's also the story of, obviously, Sam Bankman-Fried and his whole situation in the Bahamas with his buddies from MIT, and they had a good time. And then there's even the girl who sold the list to JP Morgan. There's some hotshot girl in New York who had a list of the best clients ever, sold them to JP Morgan, got a bunch of money. It's a fake list. I can't help it. It's a fake list.
We call that the 30 under 30 list that has raised 15 billion but had 20 billion in fraud.
Don't blame the young people. The old people do it too. Bernie Madoff. Okay, don't be all ageist. Okay, everybody can play.
All right.
But when it comes to companies like Fox or Citibank or Goldman or Wells Fargo or any of the call them corporate fraud, that those are treated differently than when the 29-year-old millennial or post-millennial, whatever it is, Gen X or whatever they are, comes up with a scheme to sell a fake list to JP Morgan. Or when Sam and his buddies go to Bahamas and get an apartment with their MIT buddies and run a racket on crypto. Or when Bernie goes to the golf club in Palm Beach and runs, 15% guaranteed no matter what happens. I'll give you 15%. Just give me your money. And when you let Fox basically get away with a criminal fraud, which is not political, they've knowingly reported different. Like if I'm Citibank and I sell a bond that I know is not a bond and I collect the money for the bond and I have a prospectus and I'm like, here's my bond and it pays whatever, that's a criminal fraud. It's illegal, right? If I sell a list, it's not a list, and you have to pay me money. I've defrauded you. You have recourse, right? From not just civil, but criminal penalties. Like it's against the law, sure. Not just financial. Like we have penalties, incarceration, and corrective actions for criminal fraud to protect the trust in contract law for the flow of capital in the United States. And instead of enforcing it, they say, look at the Fox thing as a exclamation of the two sets of rules. So there's the Wells Fargo rules or the JP Morgan rules. You give me $1 billion, I give you a good time. Or there's the hot shot, the girl with the list, the guy with the golf club. You're going to jail. And I think that the biggest issue in America right now is lack of trust. And so I think decisions like this are very dangerous at a time when the opportunity, I think, is equally large.
Okay.
That's my birthday reflection is, why are you doing these stupid, like you're killing trust at a time when if there's a little bit of trust, you have so many advantages in America, capital markets and technology and at universities.
So who are you really mad at? Who are you mad at?
DOJ. The DOJ needs to make it, they say, no, you can't buy me. This is a criminal fraud. And it has a criminal resolution, which consists of statements and corrections of fact in public.
So you're mad at the settlement?
Yeah. I'm saying instead of doing there is no amount of money you can pay me, sir. Like, you've committed a fraud. And so you need to correct the fraud publicly and you need to spend $500 million on a paid advertising campaign telling everybody about your fraud, like the tobacco companies had to do. And some people are going to lose their jobs and some people are going to go to jail, which is what happens. They're going to try to put the young girl in jail, right? She's being prosecuted not by JP Morgan for civil fraud, but by the DOJ for criminal fraud.
Yeah, it's a really interesting.
FTX,
yeah, it's
no jail, no loss of jobs at Wells Fargo if you pay off. Anyway, you get that.
It's a really interesting perspective, and unfortunately, like you can understand Dominion's position. They had, they're a small company. They had no choice. I'm not knocking Dominion. No, I understand. I'm saying it should have been a door. It should not have been an available door of the DOJ. Yeah, I understand what you're saying. Yeah. I think that's a really interesting point that you really don't hear anyone make. I haven't heard this argument. Other than you.
Contract, because Tom Zosnap will tell me positive drip, deepest capital market. But if I don't have contract law, what am I doing?
Yeah.
I would like to see adherence to contract law as fundamental to the Constitution.
I like it.
I can't help you. It's fundamental. Like, it's in the Constitution. Fraud, no bueno. Like, it's existential for the whole operation here. I can't help you. Like, you can screw up, but don't defraud me, and don't use fraud as a mechanism of enterprise. Like, otherwise, I can't trust the flow of payments collapses because I don't know what's.
I'm not even arguing with you. I love the story.
So, but speaking of flow of payments, let's talk about the everything application, which is Elon Musk's soon to be revealed X.com, because I believe that Twitter will go away and X will become the application at some point in the future, which will be subscriber based, which will do everything, which will be sort of competition with Jack Ma and Alipay. Like, Elon's really not looking at everybody else. He's looking at Jack Ma, and he's like, Jack Ma created this amazing umbrella app that comms, payments, travel, shopping, entertainment. And he's wanted to do it since before PayPal. He had X before PayPal, when he was, 20 or whatever they were. He's gone hog wild into this train wreck of it, Twitter.
Twitter, there's
so he's going to.
There's no way out. There's no way out of Twitter for him.
No, he's going to run it into a tree, relaunch it as X with a subscriber list.
I think he actually has to. I think he has to relaunch it. I think he has to do. Yeah.
But I think that's the plan. I think he's managing decay to then come out with basically use Twitter as a subscriber list to give a new product to.
Yeah, it's a secondary platform, and it's just it's a secondary platform with $10 billion worth of names.
And his anchor concept will be flow of payments, which is my point. Because he's flow of payments from PayPal. He views flow of payments as fundamental to every other decision. And I think he's right.
I don't know if he can catch up.
I'm not making odds here. I'm just saying he's going to make a play and he's got resources. Tim Cook, Apple, making a play. First on the phone, then with the credit card, now talking about banking. They'll make a play. The problem will probably make a play. I don't know what they're up to. I don't know what their plan is. My point is the people that control either the big subscriber lists or the actual hardware, the screen you look at, Samsung, Apple, whoever, are going to try to leverage their way around the stickiness of financial customers, which is one of the stickiest groups in the world. It's a huge pain in the ass. KYC, they got a mortgage. I don't want to move my account. I've been with whatever.
Yeah.
They're very hard to acquire. very valuable over time, and very low mobility. And their bet is X. I'm talking Tim Cook X, and for that matter, Tasty Trade, Robinhood, and it was a different degree, betting on some mobility. That if you give them better IP and a better service, that there is mobility in those customers.
They run the risk, though. There's a risk there, Dylan, which I think that they're not. I don't know if they're going to be comfortable with it. There's two risks. As soon as they go that route, they automatically lose growth status. That's number one. Can't avoid it. You lose growth status. Number two, you bring the regulators inside of your front door, and you bring them in force, especially if you're
Why
Apple.
can't I do it with a secondary, new, like a subsidiary, 10 subsidiaries?
Because it's really hard. It's really hard. You can't, like, the regulators
You're
don't.
saying because they track it to the beneficial
Of
owner all
course.
the way to the,
Of course.
to the chairman of the top co?
Of course, you can't hide behind, you can't do a deal with Goldman Sachs, a financial deal, and not bring regulators in, just because you've done the deal with Goldman Sachs as your back end. They care about the front end. They want to know, the regulators want to know who's talking to the customers.
Who's betting the customer? Who's
That's right.
Customer formation.
That's right. So I just think, like, if you, like, I went to Apple once because we were talking to them about something. So we had a meeting at Apple. So I went to Apple. I couldn't even get in to their offices without basically signing my life away. They're
on their iPad at the front door with the whole zippity ding.
Yeah. The whole, you basically have to put a handprint down to get in the front door.
Yeah, you got to get that. They got an iPad from hell.
Yeah. I don't think they're ready for to be under the thumb of U.S. regulators. And I don't think they know.
But doesn't their decision to do the gold, and just use an example, I mean, Musk did it with PayPal. He's been to the rodeo. Right.
That was more, but that was a technology play.
Agreed.
That was a technology play. There's a big difference.
There's got to be some comfort with some version of challenger bank, regulatory and legal. If you're Musk or if you're Tim Cook, that is worth the effort because they're trying. So they're sneaking their hand up your leg. They're at the movies and they came over your knee. They're like, okay, we're going to do payments, we're going to do credit cards, and we're going to do savings. And now maybe we'll do mortgages, or maybe we'll do broker investment advisory. And you're saying they'll stop because it is a threat to their multiple as a growth company. Right?
I think it's a threat to their multiple as a growth company. And I also think, again, they have no idea, even though they think they have an idea, of what it means to be in a regulated space. They have long lived outside of, their regulators are at a distance. And as soon as you bring the regulators in-house in financial services, your entire world changes. And I just
because you have a new boss, and in terms of protocol and bureaucracy.
That's right. You can't run them over.
A different legal staff.
And you can't run them over like you're used to it. And your technology is not differentiating enough. And what you're doing is you're hoping to capture the entire ecosystem, but they don't like that. The regulators don't like you capturing.
Of course. No, I get it. I mean, that's now forget the bank. Now you're at the DOJ. Now you've moved beyond the bank. I mean, the risk for Apple is they have the perfect payment, banking, mortgage, investment system, and they give it priority on their phones. And then the DOJ destroys them. I'm sure Tim Cook is aware of that.
I don't know. But
that's why I think Elon Musk is even a better play, because he doesn't own a phone. He can just run a service at you, and he already has the PayPal, credentials to take a shot.
Yes, except he's really far behind. And
so many resources. He doesn't need to. He has the money to catch up, I would argue.
Maybe.
Buy you, buy Robinhood, buy anybody. Who cares?
Yeah, Robinhood used to have a deal with Twitter, and it didn't work out. These are groups that have already tried and failed miserably. It's a lot, it's a lot different than on paper. Some of these things sound really creative and really smart. In reality, I can see this all going the way of the challenger bank. It is not.
Well, because you from experience, and probably incorrectly up to this point, generally, there's exceptions, but believe that crossing the trust bridge with money from an existing account to a new account requires a larger investment than control of the screen.
Yeah.
Which you would say, I've spent 10 years of my life and millions of dollars and all of my time going into this building in Chicago, telling people they can trust me by showing them what I do. Like that's a point, I mean, that's one example of 1,000. Goldman Sachs could say, well, we have 100 years and all the best educated people and blah, blah, blah. But your point is that whether it's Elon Musk or Tim Cook, that their estimation of the threshold to transfer accounts over the trust bridge is higher than they think.
I do. I think it's a lot higher than they think. And I think that the complexity of the business, what they don't understand is they're going for the low-hanging fruit. And the low-hanging fruit in this industry doesn't have any value. And that's what everybody learns the hard way. That's
account size is destiny, that account number is not destiny.
That's right. And you learned that from the challenger bank space. I mean, they were acquiring accounts for $100 that were worth $1. And they learned that from the Robin.
On account number as a priority over account average value per account.
Of course. And also,
dollars.
And there's a lot of pieces to it. And then when you throw on the regulatory, the costs of running a regulated business on top of that, you end up in a situation where, the model, I mean, if Apple pulls in another, let's say 10 million people and the model drags down their value per customer across the board on their other 100 million people or 200 million people or a billion people, it's a disaster for them. I'm not one of these people that think, oh my God, this is the greatest thing ever, because I don't think so. I mean, I'm all for competition. I like it.
Because you're basically saying, well, sure, go nuts, whether it's
go nuts. Go nuts. I don't care.
Because you're acquiring the lowest value customer.
And listen.
And the higher the value of the customer, the higher the threshold of conversion is. So good luck.
Listen, for me, if Apple could turn 20 or 30 million people into being interested in finance, I'm all for it. It's great for us.
Because then they're using the Tasty IP. They're using the Tasty methodology on the Apple platform.
Of course.
And you're eating bonbons with
of course.
Lifestyles of the Rich and Famous with you and Tony are out there eating bonbons on the back of the boat.
That's not it. It's just that they're introducing a lot of people. They're opening up so many more doors.
It's a bigger audience for the
Of course. But I just think
they're going to have a hot start with low value customers, and then they're going to realize when they get above 25 grand per account or some number 10 grand that's going to go to a desert
or 3 grand, whatever,
some number that's not big enough.
My after spending a lot of time looking at all these recent deals, I just think some firms have the ability to scale sideways. They can scale widthwise. Most firms scale vertically, which makes sense because it's your area of expertise. Some firms are able to scale, horizontally, which is interesting to me, but it's a very small number of firms, and you get caught a little thin, and you sometimes
which is why you have to make up for it on volume. So that's why they're sitting there like looking at Alipay. Elon is looking at Alipay, right? And he's like, okay,
but Baba
I will run half the payments the way that Griffin runs half the order flow. I'm being hyperbolic, and I'll take, a gajillionth of a basis point on everything, and I'll take nothing from the biggest river in the world, and it'll be glorious.
Yeah,
right?
that's what they think.
If you're Apple, if you're in the boardroom at Apple, or if you're in the boardroom at Twitter, that's the only rational thought, right? Because I have this mega audience, and you're saying they don't trust you enough. As soon as they go above $1,000 in the account size, you're running into friction, molasses in terms of trust. And at 5,000, you can forget about it. And at 10,000, no one's heard your name. And they're all at Goldman directly, or they're at one of the brokers, E-Trade, Schwab, Tasty, whatever. They're not coming.
Exactly. But let's just let's see how it plays out. I just think it's a bigger PR story than it is a real story. That it's let's put it this way: it's not going to change fintech. It's not going to change the front end of fintech at all. And to me, that's like, it's not going to change people's appetite for risk and speculation and strategy. It's not going to change fintech at all. And that's where we really do need change. Like the things that are missing, I don't think Apple's going to bring that to the table. I don't think Twitter's going to bring that to the table. I don't think Elon's going to bring that to the table. The direction these guys are going is it's a scalable direction. It's not interesting to me. It's the same old crap. It's
because you're philosophically interested in reframing the way that you don't care who makes the dashboard or whose account it is. It's like the way you frame the lens through which the data must be viewed is the tasty lens, or you're looking at noise anyway.
I'm not interested in people reinventing risk-free rates. Like, that's my thing. I'm not interested in repackaging, reinventing, rebranding.
Customer acquisition.
I'm not interested in rebranding passive risk-free rates. Okay, it's of no interest to me. The government can do it in a Treasury Direct form. I mean, it's not, so whether you do it with Elon or you do it with Apple or you do it with any other challenger bank or anything else, to me, it's simply not interesting. There's nothing there.
Because you're running a different nightclub for a different group of people.
Yes, exactly. Exactly. What I'm interested in is finding the small group of people globally that are willing to take enough risk to create a completely different a
new song with the same data, but a totally new kind of music, that's so to speak.
To create their own little, let's call it asymmetric model, where they understand their downside, but their upside's unlimited. Everybody else is focused
so they basically open up a higher probability of asymmetric upside.
That's right. Everybody else
without disastrously opening asymmetric downside through position sizing.
Well, yeah, I mean, I'm okay with knowing your downside with asymmetric upside, but everybody else is focused on taking what you already have and creating a better vehicle for passive risk-free returns. That has zero interest to me. And so we do play in a completely different arena. It's a different playground, and to me, it's more.
So even in success, it's not a threat to your business.
Well, exactly. But the crazy thing about it for me is that I want to build the type of platform which is the reason why Elon is Elon and Tim Cook is Tim Cook and Steve Jobs was Steve Jobs. I want to build that kind of
Jack Ma is Jack Ma.
And Jack Ma is Jack Ma. But all those guys are building platforms for exactly the opposite person that they are.
No, but I'm just imagining like a meeting with those three people, and who knows, they may all hate each other. But like, I would say those three people have the shared vision, which is I have the audience. I want to give them everything, and the foundation of everything is flow payment.
Sure.
And then after flow payments, I'll do information, and I'll do shopping, and then I'll
they need scale. Everything
Amazon,
they do.
I would imagine the same deal, different angles, different road.
They all need scale, and they'll all eat each other alive to get to scale. Facebook will be there too.
Like there must be an Amazon bank in the pipeline somewhere, a Facebook bank in the pipeline.
They all need scale. That's just the game they play.
And you're going to argue they're all competing for low value, high numbers of small accounts.
And I'm going to argue that they're all competing for the crappiest part of the business, which is the 95% of the, listen, they're all competing on the passive risk-free part of the business, which is
and flow payments, not even passive risk-free. They're doing monthly flow payments.
Okay, monthly flow payments, prepayments. Yeah, whatever. I don't care.
Phone bills.
It's so boring to me. I mean, somebody will create the perfect thing. You'll all have your own, next to your Netflix account, you'll have your own.
Alipay.
Sure.
Jack Ma did it.
Yeah. There you go. There you go.
It's been done. It just hasn't been done here.
Yeah. It's just that every single person that uses Alipay, nobody's actually using Alibaba to do anything other than order crap or use Alipay. They're not becoming the next Jack Ma using Alipay. That's my point.
Your point is that the very thing they sell is a narcotic to reduce the active component of the thing that makes them who they are, whether it's Tim or Elon or Jack.
I'm hoping that in 10 years or 20 years, the next generation of Jack Ma's and Elon Musk's and everybody else in that category started out as a tasty trader.
So that all the filtering of all the lenses is increased probability of asymmetric upside.
That's
and
right.
managed distribution size on the downside.
Right.
Place a lot of bets and select your bets relative to the ones with the highest asymmetric upside.
Let me give you an example. We're about to release a new app, and we've been building it for about a year. And I know what everybody else in the industry is building, and maybe I'm going to be dead wrong. I've been wrong before, but we're building an app that focuses strictly on speculation, nothing else. Pure speculation.
Directional or non-directional? Or
directional, sure. Directional
but non-directional? Can I do split?
Yeah, sure. Ball? Yeah, you can do anything you want.
But it's intended more for directional.
Yeah, whatever. It's intended to get you to think about risk differently than the rest of the world presents risk. The rest of the world presents risk. Risk is a bad thing. Passive risk-free returns is a good thing because we have 75 of our biggest geniuses building the exact same app. We went out and built an app that we're about to release that says, hey, you know what? Screw that. We're going to introduce you to risk and take it however use it however the hell you want. Because
and how do you know that's not just a recipe just for a house of tears? Just a house of pain.
I fully expect that for some people,
like a drunken fool in Vegas on a Tuesday.
And I fully expect that for some people it will be. And I also expect that for other people, it will do the exact opposite. And we will create the next generation of Jack Ma's from it.
And what are you doing to increase the percentage of the contestants that sign up, that a smaller probability at the 5 a.m.
Everything that we can, everything that's known, everything that we know, that's what we're doing.
In terms of guardrails and
everything that we could possibly know, we're trying. But the importance of it is, to me, the importance of that is A, it's different. B, it completely goes counter to what everybody. That's why when you talk about all this stuff like what these guys are doing, it drives me crazy because like my mind works completely the opposite way. Like that stuff has.
They're doing aggregate flow payments.
Exactly. That has zero interest to me.
Optimized assessment of risk.
Exactly.
You're solving a different formula.
Yeah, whatever. But that stuff. But what they're doing just drives me nuts because like I care zero about that. Like when somebody comes,
they can aggregate those customers, and those customers.
Whatever, I don't even care. Maybe it's worth $100 billion. I don't really care. But like when Vanetta does a story or talks about or somebody else talks about that, they're like, "Look how cool this is." Apple's doing this with Goldman Sachs, or Twitter's doing this with eToro or Robinhood. Or I'm like, everybody's missing the point. Like this is not where we're going. This is not interesting. This is completely the wrong direction.
But at the same time, the more you distinguish between the flow of payments and the theoretical, the sort of lens for the filtering, like a special lens for the filtering of risk. But now, because you're wearing the magic light waves, now you see the world differently, and now you see that it's not about avoiding risk for the fraud of a reliable return, but it's about understanding risk and creating the highest probability that you're exposed to opportunities that could pay more than average.
Here's my thought on this, Dylan, which I think you'll appreciate. If it's something that JP Morgan, Morgan Stanley, or Wells Fargo can build, then it's not interesting.
Is that the same as Apple and Twitter? And
yes. Yeah, at this point, yes. If PayPal can build it, I'm not interested.
That's the ultimate insult to call those poor.
Here, I'll take it a step further, because whatever Apple builds, if it clears through Goldman Sachs, they can't even open an account electronically. Okay.
That's double whammy in your book.
Exactly.
Double whammy.
Exactly. Like, so when I hear this stuff and I'm like, anybody that's ever opened an account, like at a place like Tasty, and it takes you, 3 minutes to open an account, try opening an account at Goldman Sachs, and 85 pages of printed copies later, you will have an account open in about 3.5 months with signing 85 different pages. And, it's like
and you'll never see your money again.
and it's gone, as according to South Park. And it's
they
gone.
Put it into their portfolio of
whatever. My point is,
optimize.
If Goldman Sachs can do something, I don't want to be involved. If Morgan Stanley or JP Morgan or Wells Fargo can do it, I have no interest.
I hate to do this to you, but I won't even do it. Fair enough.
No, it's your birthday. You can do it.
Where you have personal accounts at Goldman Sachs.
Oh, I have personal accounts at a lot. I have a personal account at JP Morgan too. But that
I know.
But those are mostly like stuff that
that's your passive. That's savings.
More like trust stuff. That whatever.
Yeah, whatever. It's like.
We have
the point is, when they call you, my point is you're on the call sheet at Goldman or JP Morgan. Oh, and when they call you with risk products or financial products, how do you respond?
No, I've never done one single thing.
No, thank you.
No, never anything. I made one trade at JP Morgan about, I want to say 7 or 8 years ago. I made a trade at JP Morgan because I wanted to do a bond swap. And we don't support over-the-counter bond swaps. So I wanted to do a bond swap. It was 30-year, 10-year. And it took me about a week to pull one trade off, of which when I got filled, they asked me if I liked my fill. As soon as they asked me if I liked my fill, I took most of my money out of the bank because most of the money I had there out of the bank.
It was such a hose job.
Yeah. I mean, I trade 100% at Tasty and keep most of my, almost all my trading capital and capital at Tasty. I mean, there's no.
Your only traditional bank relationships are more related to estate and trust and structure than activity.
Stuff that we don't support. Stuff that we don't support through Apex or
and when
online
they pitch
brokerage.
you activity, which they most assuredly must, you decline.
There's a big note on my accounts that say, don't ever call Tom about anything.
When they call you, do you say, did you not read the note?
Did I tell you a story? I used to.
Did somebody now? You must be new.
No, they don't. They honestly never call me.
Didn't read the note.
But I think it was my mom, she's 90, and I'm supposed to manage her money, but I don't really do it because I don't have any time. So, years ago when we were bought out by TD, I had her accounts there with me, and so they would call her because there were
opportunities.
Yeah, there are opportunities, and they would go, we should really do something. And she would say, well, my son is supposed to be managing my money. And they would say, well, he's not doing a very good job.
That's what a betrayal.
Total betrayal.
Bad son to your mom.
Well, they didn't know. She has a different name, so they didn't know. Okay. So
they have some excuse. They have some excuse.
Yeah, they had some excuse. So then she would explain, he's the one that built the platform that you're on, and they would go, oh, I'm sorry.
But they'd still be like, he's not doing a very good job.
They'd still say, but he's still not doing a good job. Of which I
don't care what he did.
Of which I wouldn't argue because I didn't want to do. I didn't want it. I didn't.
You didn't want that job in the first place.
I didn't want that job. I didn't want that job. I said, "Don't worry, I got this." Yeah, I had a friend who.
So anyway, but I think that's an important. I mean, listen, I think that we're entering an era where there's going to be uniform services and access and that, and then there's going to be intellectual property around methods of analysis and thought. And I think that Tasty's in a good position for a world like that.
I have a buddy that was he ran a high frequency firm. He's one of the most successful traders in the world, and then he's built some amazing businesses. Anyway, his he comes from a very humble beginning. His mom was a professional poker player in Vegas, and he was a crazy trader all over the world, trading everything, amazing success. Well, his mom gave him some money to manage, and
because he was a star, he'd made a fortune.
He was a star, and so I said to him once, because I said my mom gave me some money to manage, and I don't want to do it. He goes, you got to do what I did. What you got to do what I do, and I go, what'd you do? And he goes, well, I gave her about a 500% return. And just told
her up like Bernie Madoff style.
He just made a deposit in the account. He made a deposit in the account,
and marked it up, and
gave her a 500% return, and said, "Hey, I killed it for you, Mom." And she never asked another question, and it was all done. He goes, "Smartest move I ever made. I didn't have to do one thing." And
and so much less, no guilt, no anxiety, no thinking.
No. I should have done it.
Brilliant.
I wasn't. Yeah.
Brilliant.
All right. Anyway, we're going off on a tangent here. But
contract law is the sanctity of global capital markets. We shouldn't be letting anybody buy their way out of accountability on contract law. Dominion is bad for America.
I love that argument. How come that argument has not been all over?
Because people don't understand that contract law is the foundation of economies, and so they think it's about politics or who said what or this idiocy. And it's not about any of that. It's about contract law as the foundation of the flow of capital, flow of payments, with the center of gravity being the United States as the most dominant weapon in any national arsenal.
He's Dylan Ratigan. I'm Tom Sosnoff. Truth or Skepticism every Wednesday, 1 p.m. Central Time. Dylan, have a great birthday. Enjoy your evening.
Structure your life, baby. Structure your life.